Have you ever done this? You look at your company's cash balance, you feel pretty good about it, and then you look at your bank statement, and that sinking feeling hits when the numbers just don't match. It's a classic headache for pretty much every business owner. But here's the thing. Think of it less like a problem and more like a puzzle. And today, we're going to give you all the pieces to solve it.
Yeah, this is the big question, right? It's the whole reason we're here. I mean, if you're recording all your transactions and the bank is recording all of the same transactions, why on earth are there two completely different ending balances? It feels like it should be simple. So let's really dig in and figure out what's going on.
So here's our game plan. We'll start by framing the puzzle itself. Then we'll look at why these differences even exist by looking at two different viewpoints. After that, we'll get practical and talk about updating your records, accounting for those annoying time gaps, and then finally, we'll build the actual reconciliation that pulls it all together.
All right, Section 1, the reconciliation puzzle. This is really the heart of the conflict. You know, in theory, your cash book and what the bank says should be tracking the exact same pool of money. Logically, you'd think they should end up with the exact same number at the end of the month, but they almost never do.
I mean, in a perfect world, your books would be a perfect mirror image of the bank's records. Every deposit, every withdrawal, all lining up perfectly. But we all know reality is just a little bit messier than that, right? And that gap, that little bit of mess between theory and reality, is exactly why this whole bank reconciliation process is just so incredibly important for any business.
So let's move into Section 2, because this is probably the biggest piece of the puzzle right here. The reason your numbers don't match usually isn't about someone making a huge error. It's really just a matter of perspective. You and your bank are looking at the exact same money, but you're looking at it from completely opposite sides.
Okay, check this out, because this is the aha moment. From your business's point of view, the money in the bank is an asset. It's yours. You own it. So when you get more of it, you debit your bank account to increase it. But from the bank's perspective, they're just holding your money for you. To them, your money is a liability. It's something they owe back to you. So when you deposit money, their liability to you goes up, and that's recorded as a credit. It's the same money, just a totally different point of view.
And just to really hammer this home, let's think about what a liability is. It's just an amount owed to someone else. It's an obligation. So when you put cash in the bank's obligation to you gets bigger. That is why your positive, favorable balance shows up as a credit on their statement. They owe you. Seriously, once you get that, the whole puzzle starts to make a lot more sense.
All right, on to Section 3. Now that we get to whole perspective thing, let's start sorting the actual items that cause the balances to be different. The first group we'll look at are things the bank has already processed, but you haven't put them in your books just yet.
And yep, here are the usual suspects. The bank isn't going to send you a text message every time they ding you with a monthly service fee, right? Or when a customer makes a direct deposit you weren't expecting. You're only going to find out about these things when you get that statement. Stuff like bank charges, interest, and those automatic payments, they always hit the bank's records before they hit yours.
And this quote just says it all. The process is one of discovery. Finding a direct deposit from a customer on your bank statement isn't a mistake. It's just the normal flow of information. So your very first step in this whole reconciliation process is just to play catch-up and get your books updated with everything that's already happened at the bank.
Okay, Section 4. Let's completely flip the script now. What about all the transactions that you've already recorded, but they haven't even shown up on the bank statement yet? This is the second major reason your numbers won't match. We call these timing differences, and they're super common. Let's say you write a check to a supplier on the 30th of the month. You, being a good bookkeeper, record it right away in your payments journal. But what if your supplier doesn't get around to cashing it until the 2nd of the next month? Well, it won't be on this month's statement. Same thing goes for a deposit you made late on the last day of the month. It just hasn't cleared yet.
And this is so important to remember. These outstanding items are not errors. They are perfectly normal. It doesn't mean you did anything wrong, and it doesn't mean the bank made a mistake. They are just transactions that are caught in transit, stuck in that natural time gap of the banking system.
And finally, Section 5. Let's bring it all home. We figured out the two main reasons for the discrepancies: perspective and timing. Now we're going to use a really simple two-step process to make those two balances finally shake hands and agree.
It really is this simple. Step 1 is all about getting your own house in order. You take all those things from the bank statement, the service fees, the interest, those direct deposits, and you update your own cash journals. That gets your book balance to what it's supposed to be. Then Step 2 is about building the bridge. You list all those timing differences, the outstanding checks and deposits, on a totally separate document to connect the two numbers. And that separate document, that bridge, is called the bank reconciliation statement. Just think of it like an extension of your bank statement, a kind of worksheet that you prepare. It starts with the bank's balance, and then it adds and subtracts all those timing differences until, voila, it matches the corrected balance in your books. It's the final, satisfying piece of the puzzle.
So if you only take one thing away from this, let it be this. Bank reconciliation isn't about some big fight to prove that your numbers are right and the bank's are wrong. It's not about that at all. It's about alignment. It's about taking two different but perfectly valid records and just getting them to tell the same complete story.
So once you get really good at aligning your past records, you kind of unlock the ability to see the future a little better. Knowing your true cash position gives you so much power. So the question to leave you with is, now that you know how to do this, how can you use that clarity to make smarter, better predictions about your future cash flow? Now that's something to think about.